Hi there, and welcome to the chart patterns video. We're going to take a look at a couple of different patterns. We're looking at the continuation set of patterns and the reversal set of patterns. The continuation set of patterns will allow us to, it gives us a high probability that the market is going to continue in the direction that it started. So if the market's moving up, a continuation pattern forms, we've got a very high probability that the market is going to continue moving up, while a reversal pattern will show up at the bottom or the top of a market move. If it shows up at the top, then price is going to want to use that formation to drop lower. So we'll have a high probability trade opportunity to the short side. So reversal patterns, continuation patterns, they're very accurate and they give us a great idea which way the market wants to move. Chart patterns. Now there are several patterns that the price charts make that lead to predictable moves in the market. When you see these patterns develop, you will have a better idea which way the market will break out. Now we're going to take a look at 4 different continuation patterns or trend following patterns. First, we'll look at the symmetrical triangle or the pennant. We'll look at the ascending and descending triangle. We'll take a look at the flag formation. And then finally, we're going to take a look at the rectangle formation. The reversal patterns that we take a look at, or counter trend patterns, will be the wedge and the head and shoulders. The wedge is one of my personal favorite formations, and the head and shoulders is looked at by almost every trader that is aware of chart patterns. The first continuation pattern will be a symmetrical triangle or a pennant. Now, the description of this is the price retracts into a narrower and narrower configuration. The highs getting lower and lower while the lows are getting higher and higher. So the space between the highs and the lows become less and less. It squeezes itself from both the top and the bottom. The symmetrical triangle and the pennant both show up just before the market takes off in its original direction. Here are a couple of graphical examples of a symmetrical triangle and a pennant formation. With the symmetrical triangle, the market gently eases into the formation. It doesn't come from a steep up or down. Gently eases into the formation, while the pennant comes from a very sharp, quick move by the market. This long, sharp, steep market move in front of the pennant formation is called the pole. In the 2 examples, we have a bear example and a bull example. We'll take a look at the bear. Market comes down from above in a fairly quick motion, and then it finds a low, a bottom, and then it moves up, and then it moves down, and then it moves up. But as it's making these up and down zigzag, it's getting compressed. It's becoming narrower and narrower. And finally, the market will break out, and over 70% of the time, that breakout will be in the direction of that first initial trend, which was down. In the second example, we have price coming from below, moving up quite sharply, and then zigzagging sideways. But as it's going sideways, it's getting narrower and narrower. And again, the likelihood of a breakout will be to the upside because it is a trend following formation. This happens, this trend following formations will happen in the middle of a bigger market move. Next, we'll look at the ascending and descending triangles. Now, similar to the symmetrical triangle, but in this case, the leading edge of the triangle is a flat line, a horizontal line of support or resistance. The descending triangle we've got an example of, and there's an example of the ascending triangle. The descending triangle hits a level of support. Now, price comes down, hits the level of support, gets rejected off that level and moves up. Comes back down, hits the same level of support as it did earlier, but it can't make it as high as the first move up. Now, eventually that level of support will be broken and price will drop through it. And this is the continuation pattern. And for the ascending triangle, same thing. The price rises up to a level of resistance, drops back down, comes back up to that same level of resistance. The next drop back down isn't as far as its initial drop. And eventually the price will break through resistance and continue moving upwards. Next, we're going to take a look at the flag formation. This starts off generally with a large, quick move, forming a fairly steep pole. Next comes the flag formation, and it generally moves up and down in a zigzag formation, but slightly against the initial move. To be a true flag formation, the formation takes place between two equally separated lines, a small support and resistance channel. Here's a couple examples, a bear flag and a bull flag. The bear flag is formed as a slightly rising formation. So the initial move is down, and then the zigzag sideways movement that it does will be slightly rising. It'll be in the opposite direction. So the first initial move is down. The flag formation itself will be the zigzag motion that the market makes, and it will slightly have a rising look to it. And then finally, it will break down quite aggressively. A bull flag comes from below, moves up quite sharply, and then in a period of pause or consolidation, it makes a very tightly narrow zigzag formation, up, down, up, down. And as it does this, price tends to fall off just a little bit, starts to slope down. And then finally, when it does get its momentum back, it'll take off in the original upwards direction that the market was going before it got into the formation itself. The rectangle, this is a range. This range-bound market is essentially what a rectangle is. As price slows down after a bigger move, it will want to drift sideways for a bit. Price floating up and down as regular business in the world influences price, but it's pretty stable. There's a nice agreement on the current price, so the fluctuation is minimal. Price action that you can sandwich in between two horizontal lines, support and resistance level. You will find this formation after big moves, but also after the major market participants go to sleep on the smaller time frames, like the 1 hour. A pause in the market that is clearly defined high and lows, and it can be very, very narrow, as in a consolidated market, or a little bit wider, and there's actual price movement inside of it. This is a classic formation for breakout type of traders. Traders that like to trade the breakouts are usually looking for this kind of rectangle formation. Now let's take a look at a couple of reversal patterns. First, we'll take a look at the wedge. This happens almost every time a decent reversal is about to happen. The bullish wedge, price must be trending lower, as in a downtrend. And at the bottom of the trend, the last couple of lows are very shallow. So shallow, they're almost like they're bottoming out. The first low is followed by a slightly lower low. The highs, however, are not as shallow, and they keep moving down quite aggressively. Here's an example of both a bearish and a bullish wedge. The bearish wedge, we've got a topping out of price as price narrows, and then the reversal happens. So you take a look across the top of the bearish wedge. Price moves up, and then it starts kind of zigzagging sideways. The top of the market, though, is making very slightly higher highs, but it's not dramatic, where the lows that are being made by the zigzag sideways motion are a little bit higher. Each low is higher and higher at a more dramatic angle than the top, and it forms a pinching formation. Finally, market will break down, but it will break down in the opposite direction of the initial move. So in a bearish wedge means the market wants to go down. What market is calling for a bear move. So the market has to climb first, form the wedge, and then break down. Or a bullish wedge, it's the exact opposite. Market has to come down, hit a bottom, zigzag sideways and a little bit down, but the bottom of the formation is going to be almost flat. It'll be sloped down a little bit, and then the top part of the zigzag, the consolidation, is going to have a steeper slope to it. Now the market is going to break out, and it will be in the opposite direction. So in a bullish wedge, market comes down, makes a formation, and then breaks out to the upside. Now the head and shoulders. This might be the single most popular chart pattern out there. There are traders that look for this formation almost exclusively, and they do very well trading it. It consists of a high being the left shoulder, followed by a higher, making the head, and finally there is another high that is lower than the head, being the right shoulder. This is your classic bearish head and shoulders formation. We've got the left shoulder high, price drops down, makes a higher high, then you've got the head because it's the highest high. It looks like a person, the head and the two shoulders. And then price drops down again, comes back up, can't make it as high as the first, as the middle high there, the head, and we get that shoulder formation, and then a breakdown of what's considered the neckline, and that'd be the lows that are made during the formation. We get a break below that neckline, and price is off to the races. This particular one was a bearish pattern, and it starts out with a higher high and a higher low. What follows is a lower high, and this interrupts the pattern of an uptrend and is the beginning of a downtrend. Remember, an uptrend is a series of consecutively higher highs and higher lows. The head and shoulders formation, what we're looking at, is the end of an uptrend with the consecutively higher highs, and this starts with a lower high. So we're looking at the transition from the series of higher highs to the transition of lower highs. The head and shoulders pattern assumes that the beginning of a new trend direction will have some follow through. So we're looking at the exact point of a change in the trend direction. The bullish version of the pattern is also called head and shoulders, but it's the inverted head and shoulders. It's upside down. It's like a bat hanging from a ceiling. You can see the formations and the inverted head and shoulders. This is the second image. Price comes down, makes a low, comes back up, makes a high, comes back down, makes another low. This is a lower low, so we're still in that downward trend. Price comes up, makes a high, so we're still in the trend because the high isn't quite as high as the first high. But now it makes a low that's not as low. If it was a trend, the low should be lower than the previous low. In this case, it is not. It is higher than the previous low. And then as price breaks higher than the recent high, we have a legitimate change in trend direction. And again, the trend is defined by a series of higher highs, higher lows, or a series of lower highs and lower lows. And when you take a look at the head and shoulders, it goes from lower highs and lower lows and changes to higher highs and higher lows. That's it for the chart patterns video. I hope you got something out of this. You take care, and we'll see you in the next video.